It's 2019. You have $18,000 sitting in a savings account earning 1.4%. You've been watching the market for 2 years. Every week there's a new article. Overvalued, bubble, correction coming. Smart people are saying it. Charts look stretched. The Shiller PE ratio is at levels not seen since 2001. So you wait. You're not stupid. You're disciplined. You're going to buy at the bottom. 2020 comes. The crash happens. The S&P 500 drops 34% in 33 days. This is it. Exactly what you were waiting for. But you don't buy. Because now the news is worse than ever. Pandemic. Unemployment at 14.7%. Nobody knows how long this lasts. It feels like the wrong time to put money in. The market recovers in 5 months. By end of 2020, it's up 18% from where it started the year. By end of 2021, it's up another 28%. Your $18,000 is still in the savings account. It's now worth $18,504 after 2 years of interest. The market is up 67% in the same period. Your $18,000 invested would be worth $30,060. You waited for the crash. The crash came. You still didn't buy. And you're $11,556 behind where you would have been if you'd done nothing except invest on the day you first thought about it. That's not bad luck. That's the strategy working exactly as designed, against you. Before you close this, I know the objection. You're thinking, but the market is overvalued right now. Interest rates, geopolitics, debt levels, this time it's different. And you might be right. I'm not here to tell you a crash isn't coming. I don't know when the next crash is. Nobody does. Not the analysts, not the hedge funds, not the people with the scariest charts on financial Twitter. What I'm here to show you is the math on what waiting costs. Not in theory, in actual dollars, over actual time periods, with the actual behavior that real people exhibit when the crash they were waiting for finally arrives. Because the problem isn't the waiting. The problem is what happens when the moment you were waiting for actually comes, and you still don't pull the trigger. 3 things we're covering. First, what the real cost of sitting in cash actually looks like when you calculate it honestly. Second, the strongest case for waiting and the hidden assumption that makes it fall apart in practice. Third, the specific situations where holding cash and waiting genuinely makes sense. And at the end, a 3-question framework to figure out whether you're being strategically patient or just afraid, dressed up in the language of strategy. Meet James. He's 32, works in finance, which makes this more painful. Makes $104,000 a year, has $24,000 to invest. January 2017, James decides the market is too high. He'll wait for the pullback. He puts the $24,000 in a high-yield savings account at 1.8%. The market goes up 21.8% in 2017. James doesn't invest. He waits. 2018 brings volatility. A 20% correction in Q4. James gets close, but the headlines are bad. Trade war. Fed raising rates. He waits. 2019. Market rips 31.5%. James is now convinced a crash is imminent. He reads 3 books about market cycles. He waits. 2020. The crash comes. 34% drop. James has $25,306 in savings after 3 years of interest. But he doesn't buy. It feels like the world is ending. He waits. By December 2021, 4 years and 11 months after James first decided to wait, he finally invests. The market has returned 114% from January 2017. His $24,000 invested in January 2017 would be worth $51,360. His $25,306 in savings, invested in December 2021, starts growing from a much higher market entry point. James didn't lose money. He did everything responsible. He just cost himself $26,000 in growth, approximately, by waiting for the perfect moment that he couldn't recognize even when it arrived. Here's the number that doesn't get calculated. James spent roughly 1,800 days waiting. Each of those days, his $24,000 was losing ground to a market that doesn't wait for anyone. The cost of waiting isn't just the returns you missed, it's the compounding on those returns. It's the contributions you didn't make during those years because you were waiting to invest properly. It accumulates silently. It doesn't show up on any statement. There's no line item called cost of hesitation. But the money is gone. Here's the best argument for waiting, and it's genuinely strong, so I want to give it to you straight. If you had invested $10,000 at the peak of the market in October 2007, right before the financial crisis, your portfolio would have dropped to $5,500 by March 2009, a 45% loss. It would have taken until 2012 to get back to break even, 4.5 years to recover what you had. Someone who waited and bought in March 2009 at the bottom would have doubled their money by 2012. The difference between peak buyer and bottom buyer over that 5-year window is enormous. That's the argument. Buy low, wait for the crash. It's logical. The data supports it in isolation. But here's what that argument quietly assumes. It assumes you will recognize the bottom when you're in it. It assumes that in March 2009, with Lehman Brothers gone, unemployment rising every month, and every financial commentator saying the system might not survive, you will have the conviction to put money in. Study after study on investor behavior shows the same thing. Retail investors don't buy at the bottom. They buy after the recovery has already started, when it feels safe again, which means they buy at prices 20 to 40% above the actual bottom. The person who waits for the crash, in practice, doesn't buy at the crash. They watch the crash happen and wait for confirmation that it's over. By the time they're confident, the opportunity is already 30% in the past. There's also a data problem with the buy the dip argument. From 1926 to 2023, the U.S. market has been at or near all-time highs approximately 30% of all trading days. Investing at all-time highs and holding for 10 years has produced positive returns over 90% of the time. The market being high tells you almost nothing about what happens next. That's not opinion, that's the historical record. I promise to be honest. Here's the honest part. There are real situations where holding cash and waiting is the right call. If you have a specific, defined time horizon of less than 3 years, you're saving for a house, a business, a major life transition, you should not be in equities at all. Not because a crash is coming, because you can't afford to be wrong on timing when you have a deadline. If your current emergency fund is less than 3 months of expenses, investing before building that buffer is a mistake. A job loss or medical event that forces you to sell investments at a loss is worse than missing a year of market returns. And if you genuinely believe, based on specific analysis, not general anxiety, that a particular asset class is mispriced in a way you can quantify, holding cash for a defined period with a defined entry trigger is a legitimate strategy. The key word is defined. I'll buy when it drops 20% is a strategy. I'll buy when it feels right is not. The difference between strategic patience and paralysis is whether you have a specific condition that would make you act, and whether you'll actually act when that condition is met. Here's how this story usually goes, not the backtest version, the real one. Year 1. You have money to invest. The market looks stretched. You do research. You decide to wait for a better entry. This feels smart. Year 2. The market goes up. You feel validated in your caution. If it went up this much without you, the correction will be even more dramatic. You wait. Year 3. A 15% pullback. This might be it. But 15% doesn't feel like enough. The articles say more is coming. You wait for the real crash. Year 4. The market is now up 40% from when you first thought about investing. You start to feel the pain of missing out. But entering now at these levels feels even more reckless than entering 2 years ago. You wait. Year 5. Something breaks. A real correction. 25% down in 4 months. The news is terrible. This is exactly what you predicted. But now you're scared. Because if you predicted this, maybe you can predict what comes next. And what comes next might be worse. You wait. Year 6. The recovery. The market is back to where it was, then higher. You invest. Finally. At roughly the same price you could have paid in year 1, except you missed 5 years of growth and 5 years of contributions. Not one of those decisions was obviously wrong in the moment. Together, they added up to one of the most expensive strategies in investing, doing nothing while calling it discipline. 3 questions. Answer them before you decide to keep waiting. Most people think, is the market overvalued right now? They find data that says yes and use it as permission to stay out. The right question is, what is the specific price level or condition that would make me invest? And am I actually committed to acting when that condition is met? If you can't name a number or a trigger, you're not waiting strategically. You're just waiting. Most people think, what if I invest and it drops 30% next month? The fear of that scenario keeps them in cash. The right question is, what is the actual cost if I'm wrong about the crash, meaning it doesn't come, or doesn't come for 3 more years? Run that number. Calculate what staying in cash costs you per year in missed returns. Most people have never done this math. Once you do, the fear of being wrong in the other direction becomes real. Most people think, I'll invest when things are clearer. They're waiting for certainty. The right question is, has there ever been a period in market history when things were actually clear? 1995 felt uncertain. 2003 felt uncertain. 2012 felt uncertain. 2016 felt uncertain. Every year that produced strong returns felt uncertain while it was happening. Clarity is not a precondition for good returns. It's a feeling that never arrives on schedule. 3 things to hold on to. Waiting for the crash is not a conservative strategy. It is an active bet that you will outperform the market through timing, a bet that professional fund managers lose 85% of the time. The crash you're waiting for will not feel like a buying opportunity when it arrives. It will feel like confirmation that things are about to get worse. That's why most people who wait for the crash still don't buy when it comes. The cost of waiting is not the returns you missed. It's the compounding on those returns over the years you spent watching from the sideline, multiplied by every contribution you didn't make during that time. If this changed how you think about it, send it to someone who's been waiting for the right time for the last 2 years. That conversation might be worth more to them than any market timing decision they'll ever make.